NEOS XQQI, the 21% Nasdaq income ETF. Is it right for retirement accounts? Hey guys, it's Doug the Retirement Guy with all your monthly ETFs. So we're taking a breakdown today on the new NEOS XQQI. This has been coming across a lot of the YouTube chats, our Patreon chats, people asking questions. Boy, I liked QQQI, but with this new X, I think this is even better, getting 21%, a big increase. And people are starting to make changes to that. And I wanted to break it down to find out, is this good for retirement accounts? Is it, smoke and mirrors again? I want to give you the true hardcore, honest answer of this fund and see if it works. So grab your favorite mug, fill it with your favorite beverage, sit back, relax, and let's learn a little bit about NEOS's XQQI. So the disclosure we have to do, the presentation is for educational purposes only. It is not financial, legal, or tax advice. Past performances do not guarantee future results. And if you need financial help, always talk to a financial professional. Hey guys, before I go any farther, I got to do an announcement. Man, I wrote a book, Living on Dividends, the 3-bucket retirement system. So many of you have asked questions about it. How do you do this? How do you do that? I thought it was perfect to sit down and take time while I was away and sit down and really write my first book ever. Just trying to help everyone out. And I came up with this beautiful thing, and I can't believe I actually did all this. But Living on Dividends, the 3-bucket system. It's available on Amazon. You can get it in Kindle version. You get it directly from Amazon as a printed book, or you can go directly to our website, use the QR code, use the links down below. You can go directly to our website and order the book. And if you order from the book, I'll autograph it for you. I'll put in my autograph in it just so you have an autographed version of something different you can't get from Amazon. It's all the same price, doesn't really much matter. But get it from wherever you get your favorite books at. I think it's one of the best things going right now. So let's take a look at XQQI. What is this and where's it coming from, and give you some real information. Well, the NEOS boosted, which is another word for saying leveraged, Nasdaq 100 High Income ETF, the ticker XQQI. This one released in February 2nd of 2026. Now, this thing already has $277 million in net assets involved. The management fee of 0.98 annually, so that's talking $98 for every $10,000 that you invest into it. Remember, management fees mean something if you're carrying this for long hauls, like in a retirement account. You're going to probably haul this thing for 10, 20, 30 potential years. So you got to always make sure your management fees are in line with your costs. Now, it still pays out a monthly distribution. So right off the bat, some of the checklists. One, launch time. It's too new for me to really get involved into it as of yet, so I do not own this, because I need to have at minimum 6, but realistically something more like 12 months, especially in today's markets. I want to see 12 months of history so I have something to bank off of, because taxes are going to play into it and there are a lot of different pieces to it. The positive is the net assets is over that $50 million point. So realistically, it's not going to get liquidated. Everything has potential that it could, but it gives us that better security that it doesn't. Now, the distribution rate, 21.19% as of July 31st. This is the number that they've, NEOS posted on their website, putting it out there, 21.19%. Now, the red, the SE 30-day SEC yield, negative 0.34%. Why is that concerning? Well, that number right there tells you only what the dividends and interest charges that they collect from their fund. When it's a positive number, it means they're collecting dividends and interest up and over expense ratios that will help the fund attain that 21%. But because of the 0.98%, which is already deducted from this, you're at negative numbers. So they're not collecting enough dividends and interest even to cover their annual percentage. So that means the fund has to do the covered calls and generate premium income more than with having dividends and interest. So the target analyzed range is pretty much 19 to 23%, which is what NEOS's management have said. This is our target to do this. And they're using the 150% or 1.5 times the Nasdaq leverage, basically of the Nasdaq 100, or better answer, of QQQI. So the big numbers here, which got a lot of the people interested, and I'm going to break it down even more for you, but the 21.19%. Now, this is not a dividend strategy because it tells you that the negative SEC yield is actually saying that the interest and the expense fees and all that are pulling the fund down, making more pressure on the options premium. Now, they use a synthetic income. The fund manufactures cash flow by selling the volatility on the Nasdaq 100 index. Okay, cash versus return. Distributions rate measures cash paid to investors, not the fund's actual investment profits. And there's no guarantee that these numbers are going to continue to exist without having some decline. So, and this does not give you the total return, which I'm a guy I'm not looking at 21%. I mean, I'm seeing it, but I want to sit down and tell me right now, what's your total return? Because I see a negative number, which means you're not covering your nest egg, but I want to see, is this 21 actually going in my pocket, or we have something different? Now, for retirees, this one scares me a little bit because, you get burned once. You get burned twice, you stay away from the hot burner on the stove. Well, when you tell me you're using 1.5 leverage, and then I explain it to you, their layer one is core equity portfolio. It's a premium investment designed to replace or replicate 100% exposure to the Nasdaq 100 index. Then they're going to lay in synthetic over long-term positions. So it's like a second layer of calls, of options. The options-based layer, which are buy, calls, and selling of puts, that provide the additional 50% exposure without purchasing underlying stock. That's what synthetic world means, is that they're not buying anything, they're not doing anything. They're basically, I call it using credit. It's the simplest way I can explain it to somebody, is that they're basically using credit. So the call option overlay is writing index call options against the boosted portfolio to generate substantial premium income and monthly distributions. So you have layer one, which is like QQQI, layering it all out, and you're replicating the Nasdaq 100 that diversifies your basket, and you're getting basically your call options. Number two, you're putting a synthetic on top of that to boost that 50%. And your layer three is giving you that boosting the portfolio itself again. Now, understanding that this is a normal system, normal operating way of doing things to generate even more income. So when you compare this to XQQI with QQQI, let's lay it out. Expense ratios is 0.68 to 0.98. So considerably more money because there's more work to do. QQQI has 100% of the Nasdaq 100 index while they're 150. Their strategy is the Nasdaq 100 exposure plus index option income strategy, which gives you the high monthly income with potential participation, while they're trying to do the same framework plus adding on those synthetic long exposures, trying to boost that thing to that 19 to 23% target. Now, I want to do this thing right here, takeaways. The QQI adds the boost layer to the existing QQQI framework. So it's like you took QQQI and then you're going to build another house on top of it. It's resulting in higher fees, significantly increasing the complexity and magnifying your market risk due to that leverage exposure. So let's take a look at the yields. So QQQI has a 14.01% estimated, I call it estimated because it's what they're forecasting out, for QQI from NEOS. Comparing that to the boost is 21.19. So we got a substantial, almost 7.1% difference between these two. Year-to-date yield, which is, I'm going to tell you, is from February to August. I wanted to be apples for apples here, 8.2 compared to 12.07. So now we're talking darn close to a 4% difference. 62-cent payout versus an 80-cent payout. So I understand where people are going from, and your winner is XQQI when you're dealing with yield and the income sector. But remember from the channel, yield does not mean anything. It's a mathematical number. So if you're chasing yield, you're jumping on XQQI and you're riding that boat because you're smiling because you're getting 21%, hopefully, in yields across the board. Now we take a look at what the growth of the funds are. XQQI is actually down 0.64%, while QQQI is up 0.71%. These are putting to you as year-to-dates. So you can see that you're almost doubling. QQI is double the winning point of what XQQI is. So now you have to take this from your income yield and reduce that down. You can see they follow the marketplaces, and I'll tell you right here in June, look at the big giant spike where they went up to almost over 10% growth. That is the leverage kicking in. But take a look at the April and take a look at the August. That is the leverage, the negative side of leverage, kicking in. So even though you can go up 1.5 times, you can go down 1.5 times just as easy. And this is what's happening. It came up to its peak of high at 10%. It's now dropped down to a peak of almost 10% drop off, and it's recovering back. It takes more time to recover when it drops. So let's take a look at total returns. Well, QQQI wins again, 12% to 10.63. So when someone sits there and tells me, "Hey, I'm making 21% yield," and I'm not gonna say that to this one because you got to remember we have to use that year-to-date number. Okay. That year-to-date number, you're still less. So the maximum you're making on XQQI is 10% compared to 12% that you made on QQQI. So you can see still that QQQI is still the winner in the game. So when I look at head-to-heads, this will give you the best package across the board. And I got a little crazy with my Qs. I can see that one. XQQI. Year-to-date yield, 12.07. You take away the growth that's loss of 1.44%, gives you a total return of 10.63% total return so far for the year. QQQI, 9.38% yield, plus a 2.62% growth for a 12% total return. Now you see why Doug always uses total return numbers when he evaluates things. Is because I could chase 12% yield and be ecstatic about it and thinking I'm going to get to 21%. The question is, what's going to happen the rest of the year to the growth number? Are we going to see positive growth or negative growth? Now, you know, I'm positive on NEOS. I think they're a great company. Even with Goldman Sachs buying them, I still think they're a great company as a whole. But math numbers mean math numbers. And total return means total return. So I'm not getting my 12%, I'm getting 10. QQQI is giving me 12 and I'm getting 12. A little bit of growth with a little bit of income. So based on planning versus yield chasing, this is where things really become crazy. If your need is 6%, so we talk a lot about this, is the annual income gap. Let's say your income gap is $30,000. That means you need 6% from your $500,000 portfolio. Well, I can see why everyone jumps and says, whoa, I get 21%. I only need 6. I'm perfect. I'm ready to go. But to get that 21%, the risk that's out there is so much higher than trying to find a 6% basic down to earth total return fund. So I'm not trying to say it's a bad, good, bad, or ugly, but I'm just saying that you're shooting for 21 because you're chasing yield and you're not chasing the underlying assets of the fund and how the fund works and what's all part of it. So what happens is exactly this. You take a $100,000 hypothetical $100,000 investment into the fund. You're going to collect $21,000 in that 1 year. You're like, woo, baby, I got $21,000 off of a $100,000 investment. I'm golden. But you then take a look at your NAV, it drops down. So your $100,000 is only worth 85 and you collected 21. You really only collected 6. So this is why I tell everybody, you don't chase yield. You have to look at total returns. You have to see your principal should maintain itself, and if not, grow. Then you can take off your yield or your income and say, this is what I actually collected. So understanding the systematic long positions, what they're doing here. So I want to explain people what this is all about. So what you're going to do is you're going to buy the Nasdaq 100 calls. You're going to provide the right to participate in the index gains above a specific price point. Okay? So what I'm going to do is I'm going to sell you, we're just going to say the fund's selling for $50. Nasdaq's selling for $50. I'm going to say I'll sell this to you for a fund that will go to 52. If it gets to 53, 54, you're in the money. You're making money from it. So I'm going to sell it to you, say 52. I'm also then going to go out and sell a NASDAQ 100 put. It assumes that the obligation to buy the index at a specific strike, creating that downside risk. So what I'm doing is I'm creating income from the NASDAQ buying, you're buying it, the base equity. Okay, but I'm also going out and covering my tail of selling a NASDAQ that could drop as well. So I don't have anything to sell. I'm doing it through the synthetic that is potentially there. So the $100 base portfolio plus the $50 synthetic gives me exposure of 150%. So it gives you the difference there. You can see where you're doing two different options all off the same package. That's why leverage is so scary. If they work, great, you're multiplying yourself up. If not, you're killing yourself downward. So why more exposure can create more income? Well, I'll put it in the way of gambling. You're putting more chips on the table. Okay? You're putting more chips out there. You're boosting what's going on. And I just put it in layman's type terms, and I use different things all the time. And the first one is basically the casino. You go to the roulette table and you put $100 down, they give you 100 chips. Okay? Now the guy comes over and says, hey, Doug, what we're going to do is we're going to leverage you. The house manager comes, we're going to give you some leverage. We're going to give you some extra money to gamble with. So we're going to give you 50% more. So now I got 150 chips. If I win, I'm multiplying. I didn't put any more money out. I'm multiplying my pockets. I'm going to make more money. If I lose, I owe the house more money. You see how that's the double-edged sword. So I'm putting more chips on the table to hopefully win more, but have the potential to lose more. And that's how the exposure really creates. That's why you're seeing 19 to 23% is because you're boosting it by that 0.5%. But you're also taking a lot more risk. So in retirement, I ask you, do you want more risk or do you want more security? That's why leverage doesn't normally fit in my personal portfolio, and I don't always put it out for people to have that. Now, the potential upside case, well, the early stages, like we showed you in all those charts, you actually saw this fund had about a 15% growth, which is when people started jumping onto it. I've done the history, I've done the research. Basically between February and June 30th, this thing showed a NAV return of about 15.62%. This is when people were starting to jump into it. And they're saying, look at the yield I can get, look at the growth, we're not losing anything, things are in a great time. But I call that the honeymoon stage. It's that short term. The initial loss the period often experiences the honeymoon condition of, oh, look at the great growth and look at the potential income. Everything looks great. This is why I don't jump in at 6 months. I wait 12 months out there. And you should as well, because retirement, early gains mask the risk of long-term capital erosion. Okay, so these are the warning signs and the alerts I put out there. The limited track history is not enough to tell you what the stock fund's going to do. You need to see it through some long-term market trends. You need to miss that stress test. You're missing that whole stress test of different marketplaces. The short-term duration, the honeymoon stage, and then of course the retirement context across the board. I pretty much covered this already, the magnified downside and the recovery of math, but when the fund drops that 50%, it takes so much more energy to come out of that loss to get back to 100% recovery. Okay? 20% drop needs a 25% gain. A 30% drop needs a 43% gain. A 50% drop needs a 100% gain just to get back to normal. That's why when leveraged funds you see out there drop, it takes them forever to recover. And that's not what we want in retirement funds. So that limited upside from call writing, cap upside potential. Laddered out of the money strategy. NEOS writes calls out of the money to allow some growth participation. It's a structured ceiling. The rapid Nasdaq 100 rallies may exceed the strike price, causing the fund to trail the equity holdings. So you're trading you're trading growth for income. And we get that. We know that up front. But when you start amplifying it is where you start having your bigger problems. Now, if you got time, if you're younger and you got time and you're trying to grow quickly, you got time to recover if things make a mistake. But when you're in retirement, you don't have time to fix errors. And this is the downside risk of having leverage. Now, breaking it down even more, because everyone always asks me about taxes. Well, NEOS is known for their taxes. So they do still use Section 1256 efficiency because they are still investing into the NDX index. So they have the 1256 contracts, which is the 60-40 rule, that it comes to you as capital gains taxed at 60% long-term, 40% short-term, regardless of your holding period. They use the lower effective rate. Blending the treatment typically results in lower maximum tax rate compared to ordinary income. They do the tax harvesting, and they also use return of capital. Now, how they break that down, we won't know until we get our 1099 DIV form out of it. But across the board, we can look at other NEOS funds and know that they're very, very competitive across the board. So the compelling features of XQQI strategy, well, it's an innovation setup. It's got that that replicates the Nasdaq 100 exposure to get that extra 1.5. The income potential is definitely rewarding you if they can achieve what they're doing. It gives you the tax efficiencies that were known from NEOS. There's no daily resets, though. It avoids that volatility decay of 3 times leverage funds using longer options instead of daily performance results. And it's a proven platform. It leverages the established NEOS option income framework that's used in QQQI and SPYI. So they're using a proven system, adding leverage to it, adding an extra layer to it, which will increase your income and our tax efficiency. So across the board, it gives you everything that you love from NEOS with an extra boost. And a lot of people are like, yes, that's great, love it. But the hardcore numbers I shown have not represented the strong extra risk that we have to take to get a little extra income. It's just not there yet. So my concerns in monitoring the dashboard, it's got a limited track history. It magnifies the downside. It caps the growth potential. The yield is not really there yet. And it's an untested, fund. It's untested across the board. Now, the strategic monitoring, you want to check and watch your NAV. You want to watch the total return accuracy. You want to stay focused on total return to tell you, is this thing working or not? You want to see the distributions. There are quality distributions. And we'll be looking at that in the tax efficiency side as well. We want to watch the downside capture. Compare XQQI drawdown compared to Nasdaq directly. And this is something I've always learned, is that you want to watch the underlying asset to see if a fund is actually worse than the index or equal to the index. And this will tell you, again, this gets deeper in the NAV erosion and protection, that if you have a fund that's dropping and the index is increasing, you have a problem with the fund. If the index is down, this is down, equal amounts, then you know it's not a fund problem, it's a market condition. And then you always got the positive tax efficiency. You always want to monitor that with your 1099 form. So the verdict? Well, I'm going to tell you straight out. Doug's answer to you is I would not use this in a retirement package myself. I'm not saying it's a bad fund. Here I go. I'm not trying to downplay. Neos, I love Neos. Truthfully, I do love Neos. I think they're a great company. I like their products that they use. I think they've done some great things. I think this is for other people other than retirees. So I don't think it's right. I personally will say I don't think this is right for retirement. I don't see the 21% distribution because the total returns won't hold it. I see some decline in the value to it because of the leverage. My verdict is it's too high of a risk for the little bit of extra reward and the added expense we have to be in a portfolio. There's better outfits out there that we can work with that will do similar to what we're looking for. Doug's opinion, let me know your comments down below. It's not my advice. It's just my opinion. So leave your comments down below. Maybe you have XQQI and you love it, and maybe you have it in your retirement fund. I'd love to hear from you. Most importantly, if you like what we're doing, hit that like button, and we'll catch you at the next video.